Most ATO audits aren't random. They're triggered by predictable patterns that appear in your tax return, your lodgement history, or how your business numbers stack up against those of similar businesses. If you're a business owner or you run your own show, the good news is this: you can significantly reduce your audit risk by understanding what those patterns are and fixing them before the ATO even looks twice at you. Over the last 20 years as an accountant, I've seen exactly what triggers ATO attention and what doesn't. Very few audits land on my desk, and that's not by accident. So I'm going to walk you through the 6 biggest audit triggers I see in action, what the ATO is actually looking for, and exactly what you need to do to protect yourself. Let's get into it. Now, these 6 triggers range from obvious to sneaky. Some will cost you thousands in a single mistake. Others build up quietly over the years until the ATO comes knocking. But all of them are fixable right now if you know what to look for. Trigger number 1 is late or missing lodgements. This is the simplest one, but also the most common. If you're consistently lodging your tax returns late, or worse, not lodging at all, you're putting yourself up higher on the ATO's watch list. The ATO tracks lodgement behavior, and if you're consistently late or not lodging, you become a higher priority target. Here's the cost of ignoring this. If you don't lodge at all, the ATO will do their own background research. They'll try to work out what they think your income should be based on the data they have access to. And then you'll just get the bill. And trust me, you don't want the ATO guessing your income because they're not going to guess low. The fix is simple. Lodge on time every time. Even if you can't pay the tax bill right away, lodge the return. You're always better off lodging on time and then arranging a payment plan than not lodging at all. Trigger number 2 is unreported income or mismatched income. This is where the ATO's data matching systems come into play. And if you try to dodge the system, you will get caught here. The ATO receives income data from banks, payment systems, and third parties. They know what payments have been made to you, and if your tax return doesn't match what they've got in their system, that's an instant red flag. Don't underestimate what the ATO knows about you. Don't believe me? Let's say you've got a side income of $15,000 that you didn't declare because you thought it was under the radar. The ATO already knows about it through bank data matching. That's not just $15,000 you now owe tax on, it's penalties on top, plus interest, plus the time cost of dealing with an ATO audit. You're easily looking at a $25,000 to $30,000 problem that started as a $15,000 oversight. So how are they able to do this? Well, the ATO uses sophisticated data matching from bank transactions, payment platforms like PayPal, Stripe, and Square, crypto exchanges, rental income reports, shared dividends, and foreign income sources, on top of all the other sources on the net that hint at your lifestyle, your activities, and your financial situation. Yep, that includes social media. And here's what most people don't know. Even if you've got income in a different name, like a trust or a company, the ATO can still trace it back to you through linked entities and bank account flows. So declare everything, every income stream, every side hustle, every dividend, every rental property. If the money has come into your world, the ATO knows about it. Trigger number 3 is inflated or unusual deductions. This is where I see a lot of honest mistakes turn into ATO audit triggers. The tax office isn't just looking for dodgy claims, they're looking for claims that don't make sense relative to your income, your industry, or your circumstances. There was one case where a taxpayer claimed $18,000 in car expenses using the cents per kilometre method. Problem? That method caps out at 5,000 kilometres, which equals about $4,300 in deductions. The ATO flagged it immediately. The taxpayer had to repay the overclaim, cop a penalty, and then spend months in back and forth correspondence. What they thought was a clever deduction cost them even more in stress, time, and money than they ever would have saved. So what red flag deductions can you expect the ATO to watch out for? Home office claims, especially if you're claiming rent or mortgage interest incorrectly, car expenses, using the wrong method or double dipping, travel that looks more like a holiday, clothing that isn't occupation specific, or self-education that doesn't actually relate to your current earning activities. Remember, don't claim something because your mate at the pub said you could. Your circumstances are different and your substantiation needs to be rock solid. If you're claiming it, you need to be able to prove it. Receipts, diary, logbook, the works. Trigger number 4 is consistent losses or negative gearing patterns. If your business or your investment property is showing losses year after year, the ATO starts to ask, is this a genuine business or is it a hobby? To work this out, the ATO uses something called benchmarking. They compare your business performance to others in the same industry. If your profit margins, expense ratios, or income levels are way out of line, you're more likely to get reviewed. Just 2 months ago, one of my clients went through this exact scenario. She's a high income earner with a successful primary business, but she'd started a secondary business that was legitimately in startup phase. Plenty of deductions, very little income. The ATO triggered an audit and started asking questions like, how does your client pay for their lifestyle if this business loses money every year? Now, the answer was obvious. Her primary business generates significant income and she's got a big chunk of that declared in her own personal tax return. But the ATO still made us go through the entire audit process. We had to redirect the ATO back to the right information, show them the business plan, demonstrate the startup trajectory, and basically protect her from an outcome that could have gone sideways fast if the documentation wasn't there. The audit closed in our favor, but it took time, energy, and stress that could have been avoided with better upfront clarity. So here's what you need to do. If you are generally running at a loss for valid reasons like startup phase, reinvestment, or market downturn, document it. Have a business plan, have projections, have evidence you're actively working towards profitability. That documentation is your shield. And if you've got multiple income sources, make sure the ATO can easily see the full picture. Don't make them guess. Trigger number 5, cash-heavy businesses. Run a cafe, tradie business, beauty salon, or any business that deals heavily in cash, you are already on the ATO's radar. Cash businesses have the highest audit risk because there's a perception, fair or not, that the cash goes unreported. The ATO uses benchmarking data to compare your business against similar ones, and if your numbers are outside of those benchmarks, they'll come looking. A few years ago, there was a florist who fell outside of the benchmarks for their industry. The ATO asked for evidence of cash sales, and the florist couldn't provide enough documentation to back up what they declared. So the ATO did the math themselves. They added additional income to the business to bring it in line with the industry benchmark. Then they sent the income tax bill. Then the GST bill for the missing sales. Then, of course, penalties and interest on top. What started as a documentation problem turned into a 5-figure tax debt for this florist. Plus, the reputational hit of being audited. Here's the lesson. If you run a cash business, you cannot afford to be casual with your records. You need to keep watertight systems like daily reconciliation of cash to sales, point of sale system records, not just a till, bank all cash promptly, and keep supply invoices that prove your cost of goods sold. Don't give the ATO any reason to doubt your numbers because if they have to fill in the gaps, they won't do it in your favor. Trigger number 6 is lifestyle versus declared income mismatch. This one catches people off guard. If you're declaring $60,000 a year, but you've just bought a $2 million property, the ATO is going to want to know where that money came from. Believe it or not, the ATO uses lifestyle audits to assess your property purchases, luxury vehicle registrations, overseas travel via passport data, and high value asset acquisitions. And they do this through the insurance details to confirm those assets. If your lifestyle doesn't match your declared income, they'll investigate. So if you've received an inheritance, a gift, or a one-off capital gain that funded a big purchase, document it. Get a statutory declaration, keep the paper trail, because if the ATO comes knocking, you need to be able to show them the source of the funds immediately. But let's say you are trying to do all the right things. Mistakes still happen. So here are the 3 traps I see people fall into. Trap number 1 is using the wrong method and double dipping. Here's an example. You claim the home office fixed rate, which already includes electricity, internet, and phone, and then also claim those expenses separately. The ATO will catch this instantly. Trap number 2 is reconstructing records after the fact. If you get audited and you don't have the records, don't try to recreate them. The ATO can tell. It's better to admit the gap and negotiate with them than to get caught fabricating the evidence. Trap 3 is ignoring ATO letters. If the ATO contacts you, respond quickly. Ignoring them is going to make everything worse. Even if you need more time to get your information together, acknowledge the letter and ask for an extension. Look, audits are stressful, but they're also avoidable if you've got clean records, correct methods, and defensible evidence. If you're watching this and you're thinking, I'm not sure if I'm doing this right, that's your cue to talk to someone. Get your structure reviewed, get your deductions checked, get peace of mind. And if you're just getting started or wondering if your current setup is even right, I break down which business structure you actually need in this next video. Remember, record everything and report everything.